If you could sum up the definition of the poverty premium in one or two sentences, how would you describe it?
Well, it is the poor pay more.
So when we talk about poverty, we're not necessarily talking about significant deprivation or people who are unable to pay for essentials. But what we're talking about is households where their disposable income is quite a bit less than the median.
Yes, I think it's what we're talking about. It's people whose ability to make choices in the market is constrained by their available income, really. And so I think somebody on 70% below median income will most definitely hit times during the year where they don't have enough money.
Meet over half of the working world. They are the machine that powers our society, from pouring your coffee and emptying your bins, through to caring for a relative or delivering your parcels. You may see them as essential or frontline workers, or you might not see them at all. The Invisible Worker podcast explores the financial landscape of Britain's most diligent workforce. We speak to experts in policy, inclusion, and research to understand their challenges and start to figure out how we can solve them. Hi, I'm Emily. I'm the host of the Invisible Worker podcast. So for today's episode, we're exploring the poverty premium, which is the additional amount that lower income households pay for essential goods compared to those who earn more. So they're buying the same things, they're buying electricity, they're buying food, they're buying insurance, but they're paying more to the tune of hundreds per year. And I'm here with Sara Davies. Sara, welcome to the show.
Thank you.
Would you mind introducing yourself and telling us a little bit about who you are and what you do?
Yeah, I'm a senior research fellow at the Personal Finance Research Centre based at the University of Bristol. So we're a sort of social policy centre, which, as the name suggests, we focus on looking at household money management. So looking at policies that impact how people spend their money, how they save, whether they borrow, that sort of thing.
And you're part of the School of Geographical Sciences, am I right?
Yeah.
So my understanding of geography is probably limited to having to learn the provinces and capital cities of Canada, where I grew up. So explain to me the link between geography and personal finance.
Well, initially, the link is a historic one. When Professor Elaine Kempston set up the centre 25 years ago, there were academics in geography who were looking very much at the geography of financial exclusion, so particularly where banks' branches were closing and that sort of thing. And while we are probably more social policy than geographical research, we do still retain a very strong interest in the impact of place on how people manage their money. For example, we have mapped the local poverty premium and looked at which areas incur more poverty premium than others, where the households do.
And do you see a big difference in area in terms of how people experience the poverty premium?
There were definite differences. I mean, for example, as you might expect in London, the car insurance policy was lower because premium was lower because people are able to get around by public transport, for example. So rural areas are far more likely to incur that.
Yeah, I live in London and I don't have a car.
Yes.
I bike everywhere. So I want to talk to you a bit more about the poverty premium itself and kind of get under the skin of what it actually is. Your research here is relatively new, but the idea is old and actually dates back to the 1960s. Can you talk to me a bit more about the history of measuring the poverty premium?
Yes, well, as you say, the sort of the term the poverty premium comes from an American sociologist, David Kaplowitz. That was where this sort of concept was made concrete, really, the idea that people in poverty end up paying more. It's been around since then. I think in the sort of 1990s, 2000s, after the financial crisis, was where it came back as a subject of interest in the UK. I think where Save the Children started to look at and started to identify areas where households in the UK were paying more.
Yeah, they quite famously put out a report in 2007. It was something like over £1,000 more, they said.
Yes, yeah. That was adding together all the potential costs rather than sort of calculating it on a more individual household basis. But what they were doing was, as I said, identifying the kinds of poverty premiums that households may face and then allocating a cost to that premium.
If you could sum up the definition of the poverty premium in one or two sentences, how would you describe it?
Well, it is the poor pay more. It's about looking at, and it's not just coincidental. They pay more because they don't have enough money. So I think that's quite key. And I think certainly since the Save the Children report, what we're talking about is how people with inadequate incomes negotiate markets. Basically, it very much is about how the market is not meeting their needs.
So it's a market failure.
Yes, I would say so. I think probably right back into 1960s, that's what Kaplowitz was getting at, basically. But I think very explicitly now, since deregulation of markets, we have a market in finance, we have a market in gas and electricity, and that's where the poor end up paying more.
And when we talk about the poor, I want to get into kind of the thresholds you're using in terms of your definition of who is in poverty, because there's different ways of thinking about poverty and low income.
The most used measure in the UK is below 60% median income equivalised for household size. So basically what they're saying is accounting for the number of people in your household, if you have below 60% of the median income. That's counted as poverty. In our research, we went to 70% or below, so slightly higher than that, which I think is more a measure of low income rather than poverty. I don't think there is necessarily a very clear line. So they may move in and out of poverty, and people on low incomes are still struggling and will still hit the same issues that people in full poverty hit.
That's interesting. So when we talk about poverty, we're not necessarily talking about significant deprivation or people who are unable to pay for essentials. But what we're talking about is households where their disposable income is quite a bit less than the median.
Yes, I think it's what we're talking about. It's people whose ability to make choices in the market is constrained by their available income, really. And so I think somebody on 70% below median income will most definitely hit times during the year where they don't have enough money. And that's really where the poverty premium comes in. It's because you are unable to pay the way you want to or buy what you want to in the levels you want to because you just don't have enough money.
And so this concept of a premium, so paying more because you don't have enough money, first of all, it seems entirely backwards that's where we've landed. But is it theoretical, as in is this in theory, or are people actually paying more? Are more pounds leaving their pockets?
Oh, yeah, definitely. We've all explored this issue, and without a doubt, you can demonstrate that there are ways in which people will pay more money. The difficulty or the more complexity comes from trying to calculate exactly who is paying and how much they are paying. For example, we know up until fairly recently, there was definitely a premium on paying for gas and electricity with a prepayment meter. Would people have been on prepayment meters been paying more? No, because they'd have been using less. So I think it is, to be clear, it's for the same amount. So per kilowatt, people using prepayment meters were paying more, but they probably had a lower bill because they would limit electricity use or gas and electricity use to the extent that they could afford it.
Right. So per unit of electricity, they're paying more.
Yeah. It's like for like.
Yeah, but they're consuming less units.
Yes.
So you're looking at actually the per unit cost and comparing that.
Yes. Yeah.
You talked a little bit about who is paying more. I want to explore that. So who in particular is paying the poverty premium?
Different groups of people and will be paying different premiums. Basically, that's what we were able to do by sort of quantifying and measuring who was incurring these premiums. So we found, for example, there are a lot of old people in poverty, even though actually currently pensioners actually have a lower rate of poverty than working households. There are still a lot of pensioners in poverty. They will incur certain premiums. Single parent families are another. Really, it's the same households that are more likely to be in poverty that incur the poverty premium. People, households from ethnic minorities, and certainly working households, particularly those on low incomes and volatile incomes.
I was really surprised at the proportion of working families who were sort of captured by this research, and it was close to half of all people who are paying the poverty premium are in a working household. So it's really not about people who are out of work. There was a significant portion of people who are sort of economically active but still paying these premiums.
Yes, well, absolutely. I mean, I think that's one of the things that I think Joseph Rowntree Foundation have been very clear about. Benefits and poverty is now a working household issue as much as it is an out of work a household issue.
Yeah. And, I was speaking to somebody not that long ago about some of the other connections there. And so like the rise of illegal money lending. And again, half of all people who use an illegal moneylender are in work.
Certainly payday lenders, given the name, not surprising, were there to service a working market, not to service the out-of-work households. So, that's where you get the poverty premium. The credit poverty premium, I think, is much more common in working households in poverty than non-working households.
I want to talk about how you've measured the poverty premium, because you have produced the first sort of quantification that's nationally representative. And I want you to take me through that, if you will. And would you mind starting with the framework?
Yeah, well, firstly, we obviously read through all the existing literature to try and understand how other people had conceptualised it and what premiums they found. But then we conducted quite a lot of qualitative research. So we went around the country and did focus groups with different types of households to try and understand what were the premiums that were being incurred at that point in time. This was back in 2016. I mean, for example, prior to that, mobile phones had been a big premium. The pay-as-you-go costs were very, very much more expensive than contract. But actually, we found that had gone by that point. So that was the purpose of doing a lot of background, but also to try and understand the why people were paying by that methods. And that's where we came up with a conceptual framework that was really about, as I said, interaction with the market. So we identified demand side factors, which is the choices that people in low income households make. So being very risk averse, for example, because they can't afford to lose money on anything, not being able to pay by direct debits because they're not sure they'll have the money at the same point each month, not being able to buy in bulk, those kind of issues.
So I understand not being able to buy in bulk. That's really clear. But talk to me a bit more about not choosing direct debit because you don't think you're going to have the money.
Yes, well, a lot of people on low incomes, particularly workers on low incomes, may not have a secure income. They may not be earning, on a same number of hours. They may be in and out of work. And so their income can go up and down. So that makes it difficult. Even if you have the same amount of money coming in every month, you might have an unexpected bill earlier in the month. Your children might need new clothes. Your boiler might break down. And that means that you just won't have the money there at the time. And I think companies are probably a bit better than they used to be, but there used to be quite stiff penalties for bouncing direct debits and so on. So actually it could end up costing you more to be on a direct debit.
Got it. So you choose not to, so you can manage your cash flow.
Yeah, absolutely.
And we see this at WageStream as well with people who are on hourly paid work. We see about a 37-hour average fluctuation in hours worked month to month. But we also see that paydays move. So you typically get paid every 4 weeks. So the day you get paid isn't the same.
Yes. Yeah, absolutely. Benefits were, they have now moved more to a monthly model with universal credit. But even then, sometimes they would come in different weeks and people might want to put money on their meter, for example, weekly when they get the benefits in rather than pay at the end of the month.
Yeah, or if you're receiving benefits and then something changes in your income, maybe you worked a few extra shifts or you got a small bonus, that can kind of push you off a cliff and then you lose your benefits and have to reapply.
Yes.
And that can take quite a while. So that can be quite a long delay before you get them back. So you end up in a cash flow squeeze as well.
Yes. Yeah. I think universal credit has made more people in a position where their income is a bit more variable. But also, the decisions are also about demand management in the sense that a lot of people on low incomes prefer to use a prepayment meter because it means they can easily limit the amount of money they're spending on gas and electricity.
As in they use it as a budgeting technique?
Yes, absolutely.
So they just preload the amount they want to use or that they have budget for?
Yes, yeah. And they can see if it's going down and, and so if you're spending more, you can say, okay, well, we just won't have the heating on for the next 2 days.
I remember as a kid, my dad stuck a nail in the thermostat so you couldn't move the dial above a particular temperature and he used to monitor it from the basement of the house. And if the light went on when it shouldn't have been on, he came up the stairs and he was like turning it back down.
Yeah, so absolutely. I think, particularly people with family and I think particularly teenage kids prefer to have a prepayment meter so they can monitor and constrain the amount of electricity going out.
Makes perfect sense. I don't think I was very sympathetic to my dad's cost management techniques at the time.
Yes, yeah.
So we've talked about the demand side. Tell me more about the other side of that equation, so the supply side. And particularly, I want to talk about cost-reflective pricing.
Yes, well, I think traditionally cost-reflective pricing was seen to underpin the poverty premium. So, for example, people using doorstep loans like Provident, which a lot of low-income households, particularly single mothers, use. It costs a lot more money to send somebody round to everybody's house to collect the money.
And so
weekly.
that's why it's called cost reflective.
Yes, so it's the extra cost was there in part, at least, to reflect how much it was costing the company to provide the service.
Yeah.
Well, Professor Kempson, she calculated how much it would cost on a not-for-profit basis and it was still 120% APR to provide that kind of service. So it's not a cheap way of providing credit. And equally, say, for example, going prepayment meters, again, somebody used to have to go around and empty that meter. And
someone had to go around and withdraw all the cards people had. I had no idea.
Money.
Actual money. Oh,
yeah.
Here I was imagining it. You put a plastic card in it.
Well, you do now, and probably for the last 5 or so years. But no, certainly, this is what I'm saying. Certainly back when in the 60s, 70s and 80s.
You'd be putting your 20p's in?
50 pences in, yeah.
Okay. I had no idea.
Yeah. No, my husband and I's first flat had a prepayment meter, and it would just run out when you're watching television if you didn't carefully monitor it.
That's not such a problem for the television, but then, the fridge turns off and the freezer stops working.
Yes, yeah. I mean, I think it's probably better now. But you still have gas and electricity companies and other organisations offering a discount for paying by direct debit, and yet you don't have this costs incurred anymore. With a smart meter, that could easily be prepayment meter, or it could be direct debit. So that's the other part of it, is the choices that companies are making. They're making those choices to encourage the best customers, in inverted commas, the customers that don't have issues paying. So they don't have to worry about paying money to chase debts. So they make these choices to make it easy for themselves, basically.
And they would argue that this is cost reflective pricing because those who are paying on direct debit, there's lower admin and also lower risk of default. So they know from profiling their customer base.
Absolutely, yeah. That
if you pay in this particular way, you're going to be a good customer and a good payer. Therefore, they're going to give you a discount for that. And you're saying that's
well, I would say that's literally the poverty premium.
That's literally the poverty premium.
The whole reason those people are more likely to default is because they haven't got enough money. So it's because their income is at the very low end of the scale that they are a risk. So that's the whole point, isn't it? Designating people in poverty as being risky.
And so is it then unfair to give somebody a discount because they're a good payer?
Well, it's a choice. It's a market, isn't it? And that's the point, that people in poverty don't have the same ability to negotiate these markets that people on higher incomes do.
Got it. So they can't make that choice.
Yes. Yeah.
Therefore, as a company choosing to give a discount to one particular group of customers when another group can't actually access that, maybe isn't fair.
I mean, you may be able to argue that in non-essential markets, but I think for essential markets and services, that's the whole point, is that the customer doesn't have the choice to say, no, I'll take my business elsewhere. They have to have gas and electricity. They have to have car insurance.
That's a really good point, because the poverty premium that you've measured is all about essential services. And we haven't discussed what those services are. So can we just go on a little tangent, and can you tell me what those essential services are?
Well, the primary ones we identified, and certainly the three that I think are the most impactful and the most costly, is credit, high cost credit. It's a fairly narrow premium in the sense that not that many people incur it. I think about 16% of households. But the costs for that are very large and very, deep costs. Then you have gas and electricity, and in particular, we'll probably talk about this a bit more later, about when we talk about how things change, but not switching, not being on the best tariff. And that was incurred by a huge number of people and was quite a big cost as well.
Yeah, the loyalty penalty.
Yeah. And then the other one is insurances. So both the costs of spreading payments over a year rather than paying in one lump sum.
You also talk about compounding factors. So demand side factors, supply side factors, and then compounding or exacerbating factors kind of on both sides. And geography is one of them.
Yes, but particularly for insurance premiums, because obviously they are area-based premiums, but also in terms of, say, accessing cash machines that are fee-free. There is very much a deprivation element to that.
I want to talk a little bit about behavioral economics. Again, coming right back to this concept of this perceived choice and constraints that people face. There's a concept called scarcity mindset, which I find really fascinating. And so this is the idea that when you are dealing with scarcity, it impacts your cognition, your available IQ, your decision making, so that the outcomes are actually worse than could be predicted based on the scarcity alone. And with something like financial scarcity, it's pretty relentless. So if you are managing a low income, you are thinking about money all the time. It takes up bandwidth. It's sort of a bandwidth tax. And therefore you make worse choices about money, which kind of creates this vicious circle, often described as a poverty trap. And so there's some research out of the US that shows that this affects you to the tune of around 13 IQ points. Which is worse than losing an entire night's sleep. It's worse than the impact of long-term alcoholism, but also affects your executive function. So you're more impulsive, you're less able to make good decisions for yourself. What have you seen in your research? And does that ring true for you?
Yeah, I mean, I think certainly when discussing the poverty premium with people, it's come out as a very, very strong risk aversion. And so this reluctance to switch, this reluctance to shop around, not having the energy to do that as much. But it was actually through the discussions with people and the focus groups that we felt, yes, that actually this was rooted in being on a low income, or certainly for those who were on a low income. That was a considerable reason why they didn't switch, was they didn't want to risk a company charging them twice, one company and their original company charging them. They didn't have the time to go through all of the process to make the decisions. Insurances, that's another area where it just requires such a lot of you to try and understand whether this is the best insurance for you or not, whether it's worth you getting it. So yeah, I do think that is part of why the poverty premium arises, is because we ask too much of people within markets to make these decisions, of the people who are in the least good position to be able to make them.
Citizens Advice issued a super complaint to the CMA, the Competitions and Markets Authority, in 2018. And within that super complaint, so this was about the loyalty penalty, so the idea that you pay more if you don't engage in markets and you don't negotiate a new tariff across lots of different markets. So they looked at 5. And in their super complaint, they identified that 42% of lower income households didn't have the time to engage in comparison and shopping around, and actually thinking about your compounding factors, maybe didn't have the digital access or didn't have the skills or confidence. And they named scarcity mindset as a factor in the super complaint. And in fact, their view was that providers were deliberately building tariffs that took advantage of the fact that people weren't engaging and weren't negotiating and switching, and that those people were being charged more to subsidize attracting new customers with cheaper deals.
Yes, yeah.
And I want to talk about this super complaint. So I learned a lot of things about what a super complaint is. It's not just a really big complaint. It's a specific type of complaint that a designated consumer body can make to a regulator. And when they make this complaint, the regulator has 90 days to respond. So the clock starts and they have to do something about it. They have to acknowledge it. And here's what they said in their super complaint. They said that the loyalty penalty was costing consumers £4.1 billion a year, that 8 in 10 consumers were paying a loyalty penalty. So this is not small. This is most of us were paying a loyalty penalty. And if you paid them across all 5 markets, that was mobile, broadband, savings, home insurance and mortgages, it was costing you £877 a year. That feels awfully like the poverty premium.
Yes. Well, it's another example of a market-based premium where the markets kind of say everyone has the opportunity to get the best price, but they make it very difficult for, people with low incomes, or anybody who hasn't got the time to engage fully and spend hours looking and then weighing up the decisions. They present the information in a way that makes it hard to compare one tariff with another. I think it's very similar. It has the same root cause, definitely. And I think more importantly, from the point of view of the poverty premium, it's going to impact people on low incomes more. Not least because they're people who can't afford to lose £800 a year.
Yeah, 877. That's a lot of money. Yeah. I would be furious if I found out I was paying that amount more.
Yeah. They're like, well, I'm giving you my customer. I'm sticking with you. And you're actually charging me more for that.
It's pretty outrageous. And so all these efforts were put into getting people to engage, getting people to switch. And there's some really notable failures. So the current account switching service, so getting people to change bank accounts, huge investment in making that really easy and low friction for people to do. Switching rates at the time of the Citizens Advice super complaint were 1.88%.
Yes.
So,
yeah.
Nobody's doing it. Or even you talk about putting information in front of people and making it easy for them to compare costs. Even when that was tested, that did almost nothing. So energy providers saying to you, your current tariff is ending, here's the new one. You could save money if you switched. That increased switching from 3% to 6%. So again, not really putting a dent in things at all. And the big point Citizens Advice made was that none of these were sort of normal markets. They were all essential services.
Yes, yeah. And I think, as I said, it highlighted a lot of what we know from the poverty premium. You don't want to market in essential services. You just want to pay for them.
Yeah, that's a good point. You just want to pay for them. And should you pay for them? So here's a philosophical question for you. Should we be paying for essential services, or should they be funded through tax dollars?
Yeah, well, that's a big question. I certainly don't think there should be markets in essential services. I think whether it's heavily regulated or state-owned, I think everybody should have access to the same gas and electricity at a fair price, basic banking services, water, education, all of these that you need should be very heavily regulated to ensure that people can pay for them, so that when we have a gas crisis, an energy crisis again, you're not left in the position where some people just can't pay their gas and electricity bills.
And arguably that falls back on the taxpayer anyway, because that leads to a health crisis.
Yes.
And it's much more expensive paying for that through the NHS, picking up the pieces when people are ill from cold homes, or, children aren't developing correctly because they're hungry, or they're not getting the support they need.
But also all of that support was tax funded, so we will be paying for it. Just it went into the hands of profit-making companies. So it would be better if that had been a state company that the tax money was then subsidising.
We keep coming back to the same point, which is this is a market problem and it needs a market intervention. And I wanted to run through, I would say, some notable successes kind of over the past decade or two where we've seen this improve people's lives. One of them was actually in 1999 when we launched the national minimum wage, right? A huge market intervention to say, well, actually, let's put a floor on how much people are going to earn. So that's a pretty major market intervention, which begins to move people maybe out of this definition of poverty. Is that something you've looked at in terms of people moving in and out of poverty?
Obviously, we look at household income as part of, how people manage their money. I think it's a great intervention, and now we are getting more state intervention to try and ensure a bit more equity. I mean, the other intervention that I think has been very successful, and that is pension auto-enrolment. Mm-hmm. It's not something you'll see an immediate impact on, but in 20, 30 years, you will hopefully have a group of people retiring in better position than they would have done.
And that's been hugely successful. We took private sector participation from 32% to 75%.
Yeah, absolutely.
So again, a major intervention.
But I think there has been, and there will continue to be, this sort of tussle between markets and regulation. And I think it's on all of us to kind of push for the regulations that we think will be the most beneficial.
And I think there's a really standout case, which we haven't talked about, which is Ofwat, the water regulator. They were created in 1989 when water companies were privatized. I mean, talk about essential services, right? Water. So from the get-go, from the moment of privatizing, there were price controls, and there have been ever since. A decade later, so it did take them a little while, they introduced measures to protect vulnerable consumers with the Water Industry Act. And they launched the Water Shore scheme to help low-income customers, so kind of cap the cost of water for those who had sort of essential needs. So that is an industry that since the very beginning has actually laid some really solid foundations. And I haven't seen I've seen headlines about water for other reasons, but I haven't seen big headlines about water companies in terms of vulnerable consumers. Is that fair?
Yeah, no, I mean, you're right. It is certainly an industry that has done more. And I think they also introduced regulation that you can't cut somebody's water off for non-payment, which I think you can for gas and electricity. So I think in that respect, the water industry did lead the way. Anecdotally, from the research I've been doing lately on people who are struggling with gas and electricity bills, I think companies generally are being more lenient than they would. I think people are generally not being cut off. They may be being moved to prepayment meters, which I guess you could argue is a kind of
the same thing.
Yes. But I've also seen examples of people whose energy companies gave them free, credit when needed in times of emergency. I think since the energy crisis, there has been probably a strong political will to ensure that companies treat vulnerable customers fairly. But I think it should be written into the regulation to be tougher on companies to ensure this.
I think that's the subtlety, what you were saying about energy companies. I'm not sure they can cut people off. I think they're obliged to continue the service even if you haven't paid. So you can rack up energy debt. So as somebody who consumes energy on credit and pays by direct debit, I have the privilege of racking up energy debt should I wish to, or should I stop paying for it for whatever reason. But if I were on a prepayment meter, I don't have that choice anymore. So you could argue that those who need it the most don't have the luxury of going into energy debt.
Yes. Yeah. We did do some research into this, and you get this divide between people on prepayment meters who spent all of last winter closely monitoring and having a fairly miserable winter of 2023 compared with those on direct debit or pay as you go, but they've built up big debts. And so, that's not a good position to be in either if you're low income and you know that paying off a £700 bill is going to always be a difficulty for you.
Yeah.
I mean, I think thinking about the water company, what we're seeing now, though, is that they've been saving money by not doing essential repairs. And I think you will always have this pressure between being fair to customers and making a profit if you have profit-making utility companies.
I want to talk about the poverty premium at work. And I want to talk about something a little bit different that we haven't covered yet, which is the idea that over half of the working world have to go to work. So during the pandemic, during lockdown, we described them as essential workers or key workers. And the Invisible Worker podcast is all about exploring the financial lives of this worker. And I see on social media and other forums the debate about return to office mandates and kind of work flexibility, rages on. But for over half of the working population, they don't have this choice. If you are working in a hospitality environment, you have to turn up if you're a bartender. You have to turn up if you're a nurse or a surgeon. You have to turn up if you are working at a school, and so on and so forth. So is there a poverty premium associated with having to go to work?
I think transport probably is a poverty premium, but it's so individual to households, to areas. The how you travel around London is very different to how you travel around Dorset, but without a doubt, transport and the necessity of transport to get to work, and particularly if you're a family to also fit in picking up children, means that you have to have a car if you're living in a rural area. You might have to pay taxis if you're working out of hours, which a lot of frontline workers do, working, as you said, hospitality workers, but also NHS.
And it's a cost of transport, but it's also a time cost. So the time cost of getting to work is potentially its own poverty premium, because that's time that you can't spend. Maybe you would spend that comparison shopping and switching your utilities, or maybe you would spend that finding other ways to save money.
And I think that's why working families were the ones who had the highest poverty premiums.
That's right. I remember that working families were the most exposed. And was it they were paying double the average poverty premium?
Certainly in 2016, the cluster that had the highest poverty premium were much more likely to be working households.
So does this mean that when you do your next report, is it going to include the poverty premium of going to work?
Well, I think certainly we would look at including a commuting cost and trying to find a way of calculating that. As I said, it's actually quite hard when you start to think through all the kind of different combinations and to decide, well, if people on middle and high incomes also commute, is it what counts as a poverty premium? But it's certainly food for thought.
I would love to be a fly on the wall at the next School of Geographical Sciences debate on what is in and what is out for the 2026.
You're very welcome to join us.
Thank you. We're almost done. We're going to wrap up now. I have one last question for you. This is the Invisible Worker podcast. We explore the financial lives of frontline and essential workers. And I always ask people, what is one thing about the financial lives of this worker that you just wish more people knew, that's obvious to you in the work you do, but just doesn't seem to be seen by markets or policymakers or government? So what is your one thing about this worker that you'd like to share?
I'm constantly surprised at how much organisations still base their sort of markets, their tariffs, their payment methods on the idea that people have a set wage that comes in on the same day every month. And that's clearly fewer and fewer people work to that model. And so I think it should be the onus on organisations to try and come up with ways that allow workers to pay to suit their sort of income model and the times and amounts that they get coming in. I mean, even including in-work benefits. They all work on a 4-week model. Some people still get paid weekly. Hours change. I think organisations should recognise that and adjust their expectations.
Couldn't agree more. Thank you very much, Sara. This has been a fantastic episode. This has been Sara Davies from the Bristol University Personal Finance Research Centre, and I hope you've enjoyed our deep dive into calculating the poverty premium.
Thank you.
Before you go, make sure you stay in touch. Please subscribe to the Invisible Worker podcast on Apple Podcasts, Spotify, or wherever you go to listen. That way you can follow along as we release new episodes. Thanks again, and see you soon.